This is eSec Lending Insights. Let's get over to our episode. All right. I think it's exciting. You know why I think this one's exciting?
You tell us.
I like the name of the Zoom meeting.
All right. So do you want to tell our listeners what we're doing then, Mike?
The podcast without Big Jim.
We don't have Big Jim. And I think the most notable thing about doing this podcast without Jim is that I asked the two of you yesterday, should we pod? You responded right away saying, sure. I scheduled it and we're doing it.
Doesn't happen a lot.
Proof that the process can work.
One for one, right?
Exactly.
Here's the thing, though. Jim's on vacation. We know he's going to PASLA next week, but he's on vacation. So I think the FOMO effect is just not going to work.
Yeah, I actually think even better, though, that unless our listeners give us up, which I'm sure is highly possible, especially after I say what I'm going to say, I think we can get away with doing this with him not even knowing.
Sure.
Because I don't think he listens to our own podcast, which he's on most of them. So why would you re-listen? But he doesn't listen. And if the three of us just keep our mouths quiet, he could be none the wiser.
Yep. A listener will rat us out now. If
Yeah,
Katie
I
doesn't
will
get to
also.
it before
I will also rat us out because
Yep.
knowing that I can keep my mouth quiet probably won't happen either.
Exactly.
I have plenty of self-awareness that I'm probably the weakest link. But anyway, all right. Yeah, so we can do this without Jim. We can do hard things without Jim Maroney. There's a lot going on in the market this week. I can't even believe it hasn't been a full week since the US and Israel started the conflict with Iran. But we are on a Friday, however many days into now this conflict in the Middle East that seems growing and ever expanding. It's been probably an interesting week in the market. So should we just start there and just what's been going on? Maybe not even over the last month, but just since the beginning of the week and trading and what you guys are seeing across the book.
On the treasury side and kind of the front end, it has large impacts on our market, and participants definitely keeping an eye. From a high level view, the energy crisis and the shortage and supply disruption in oil has lasting effects on inflation. So the stickiness of inflation during a period of when a lot of the market wants to remain dovish and wants to cut rates, when we have, in theory, a new Fed president taking place May 15th, who's a known dove, still has to get confirmed by Senate, but that's a whole different conversation. So some conflicting themes there. There are some people from an inflation perspective that think if you really strip out food and oil, more of the volatile kind of measures, core inflation number won't come in enough disrupted to move the Fed off its current path. But that really is just the interpretation of the data there. So what you're seeing from a market perspective is looking at the longer end of the curve. So the 10 to 30-year part of the curve tends to be the benchmark issues for all sorts of lending and borrowing, kind of just in finance in general. You definitely saw investors wary of it. So you saw a global sell-off, people trying to get out ahead of kind of inflation, moving up yields. I think last time we were talking about the 10-year breaking through the 4% optic level, and it did break through the 4% level. This week, you're hovering in the 412 to 420-ish range. It hasn't been that long since we did a podcast. And if you're looking at things that impact our markets, kind of path of interest rates, you saw a big reprice in the Fed futures markets and the swap OIS market, taking out almost a full cut for 2026. So what that does is it causes investors to have knee-jerk reactions. What we've been seeing this week is investors are keeping cash very close to the vest, preparing for things like marks, both in treasuries and equities, are going against us. So I do think there's going to be some outflows across sec lending programs that people are preparing for, but I don't think people have enough conviction or confidence in the short-term path of the fixed income curve or the treasury curve that people want to deploy cash out. You're keeping cash really short and keeping cash close to the vest. So it's different dynamics. The repo is actually seeing a lot of this money because people are keeping cash overnight. So money funds actually just hit an all-time high this week from money fund inflow. So north of 8 trillion. It's really the longer end of the curve that you're seeing the big yield, the repricing along the curve. So some of those dynamics, I think in the very short end, more of that flight to quality trade that we talk to a lot. We are seeing a pretty well bid, I would say, GC market. We've actually had pretty good overnight bids and term bids This week, utilizations remain high and continue to have borrowers looking for collateral across the board. That's all positive from a sec lending market. If you eliminate some of the noise, I think that's working as it's supposed to. The difficulty and challenge is if you're raising cash and increasing utilizations, where are you spending some of that cash? For most of the year, some of the credit spreads have been fairly tight, talking about multi-year lows. And just because it's been such an amply cash market and issuers don't have to widen out offers to attract said cash, I'm starting to see that reverse out a little bit. So some of the reluctance from investors of spending out the curve and issuers not getting done at their levels. So you're starting to see things leak a little wider, tends to
Hey,
bode
Mike,
pretty. Yep.
is that all tenors or where are you seeing it widen out?
Yeah, I think it really is all tenors. Issuers are struggling to attract the most cash is probably in the 6 to 12 month part of the curve. So you're starting to see things leak a little wider there. That tends to be where a lot of SMAs and sec lending portfolios run mismatch. Reinvestment books tend to target those parts of the curve. So that could bode fairly well if that dynamic holds true. We're pretty confident of our ability to get bids on the funding side, and then you're starting to see some assets widen out. I do think that dynamic could be positive, but I think a lot of people have to keep in mind that marks and flows and just the market that we're in is definitely risk off right now. And you have to be careful of how much of those type of trades that you're doing. But I do think if you eliminate a lot of the headline news, our biggest risk this week has just been you're coming in on the desk in the morning and you're already down a couple hundred million kind of across the program from a marks perspective. If you really think about it from just managing the liquidity on it, I think the markets have behaved pretty well. I think there's a lot to be seen still on what the Fed's going to do, what a new Fed regime looks like, and how they are going to take some of this news up until May. If the war is still continuing in May, it's going to be very hard for the new administration of the Fed to start cutting rates in June like many thought. But I think people at this part of the curve tend to be more conservative. So I do think it's going to be a very wait and see approach.
So treasury balances for lending activity still going well, still easy, good utilization, but the cash that's in the system, people are uncertain of the longer term horizon now, just given the conflict in Iran and what's going on with the macro environment, not knowing what's going to happen with the future rate environment. They're reticent to deploy that, and therefore spreads are also widening. So for those that are doing that, you're seeing wider spreads on the longer end of the curve. Is that sort
Yeah,
of
I
where
think
we are?
yeah, I think that was a good synopsis. I think on the kind of treasury demand and utilizations, I think anything this month that disrupts that narrative will be more of a balance sheet quarter end dynamic than it
Okay.
is geopolitical, which just tends to happen around reporting dates anyway. I think that's more status quo.
So, Mike mentioned a few times mark activity and concerns around the ability to maintain liquidity and keep balances where they are. That he's obviously not really speaking much about the treasury side of the business. He's speaking probably about your book on the equities and the corporates. What have you seen this week in terms of volatility? Obviously, when you do have the downward pressure of mark to markets daily, just based upon where prices are moving and shifting, that's obviously one thing. But what about the ability, just the general flow, and especially on the funding side of the trade and GC?
Yeah, great question. We're definitely seeing a mark swing a bit more wildly than we had prior to this week or so. But I guess if you zoom out a bit, it seemed like the market was setting themselves up for maybe some type of event like this, that the AI trade had deteriorated to whatever extent you want to attribute that to performance of broader equities. The S&P was already at risk of turning negative for the month of February. I think the marks, while they definitely have been a bit more acute, the sell-off prior to the geopolitical news over last weekend definitely probably helped soften the potential blow. I guess what I would say to anyone that might be concerned about marks, we get lulled to sleep sometimes when we have markets that continuously grind higher. You only have to go as far back as last spring. We had the S&P sell off 15% for Liberation Day. This is something that we do expect to happen every 6 months or at least a couple times a year. It's really challenging to predict the when and the what, but we do anticipate this. And I think not just eSec lending, but I think agent lenders and counterparties in general are really prepared for these. We try to maintain BAU. So with that, we are seeing a ton of activity this week. It was reported that there was some long buying at the beginning of the week. Mike and I saw a pickup in demand for some of the paired structures in the back-to-back trades that we work on, where we're raising cash to spend in secured funding. That's always exciting. And Those opportunities tend to wax and wane. Sometimes it does take a disruption of some type for us to see that demand come back. What's also being reported is that long boxes relative to shorts do seem to be getting a bit stretched. So we have seen some inflows, particularly when I say inflows, more borrows across Rust 2 and Rust 3 names in
Okay.
particular.
So that's because the primes just don't have as much inventory right now because their assets are being potentially sold out.
Maybe that, or maybe just more net borrowing as well.
Hmm.
And that's just my guess. We have our internal data points, and it's really apparent when you see the pendulum shift. Some of the asset manager programs that are higher risk weight, that are intrinsic focused, when you see inflows in those programs, it's a telltale sign that there's probably broad borrowing of Rust 2, Rust 3 stock.
Right. When you're not having to work as hard to get those assets out the door. Is that what you're saying?
Well,
Is your job easier this week, Mark?
the hard work's already done. There's a lot of static setup and
Yeah.
technology put in place. So if that's what you're alluding to, yes.
Yeah.
What we're starting to see as well is preparation for quarter end. I think sometimes we get past year end and then the first quarter seems to come and go, and it's not much of an event. This one looks like it will be busy. Mike and I are already seeing funding demand pick up from some borrowers, fielding questions about non-cash or for low risk weight balances for at least a few weeks, maybe longer. While the US has been really volatile, if you zoom out, I know we tend to focus on the US a lot. Some of the main index equities in Asia are up 15 to 30%. I think what we're hearing from our prime counterparts is that their books continue to grow and they're up against limits, and secured funding and managing for quarter end is under the microscope again.
Okay. Good. What about specials activity? Much of what we just discussed is general flow, a lot of funding activity, a lot of probably GC borrowing. But how about specials over the past, maybe if you want to comment since the beginning of the year, because we're not that far in, but even just in the last week or so, have you seen any change at all given the volatility?
Yep, we're seeing a pickup in demand for some ADRs. So whether it's direct attribution to the geopolitical events or it could be a trade on the dollar. So we are seeing a pickup in demand for some of those. And then in general, we've seen a number of names, some of the more retail focused names trade from GC to warm. I wouldn't call it like a 9 out of 10 event for hard to borrows, but we have seen a moderate pickup for sure.
Okay, good.
I had a question for Mike. So, Mike, I think sometimes we collectively think to ourselves if there's some type of disruption to the market, we'll see a widening of spread, credit will tighten up. Obviously, no one wants anything that's too disruptive. That's a mitigant to the industry as a whole. But how would this compare to some other recent market events? Obviously, we're reacting to this week's news, but do you see this being a benefit over the coming weeks to months?
Yeah, I think from a demand perspective of treasuries and HQLA, I think it's kind of in line of what we've seen the last few black swan events. We've seen a strong bid in the front end of the curve. I think the part that makes this a little different is the whole macro monetary policy Fed administration shift, where even if the markets were as calm as possible, we were expecting to have a new Fed governor in May. Coming into the year, look at the most recent dot plot. The next move for most officials was going to be to the downside. Coming into the year, there was 2 to 3 cuts being priced in. I would say the overall tone was maybe inflation's a little bit sticky, but the labor market's looking in really good shape. So there's maybe some room to go lower. I think some of this recent headline news is putting a bit of a wrench in that. And it's tough to tell if this is just a short term blip. But if this gets resolved within, we're talking rather weeks than months, and people understand that some of the data is going to have some blips in it, both for supply chain shocks in the energy markets, but also some of the data is being definitely skewed by some of the weather. When looking at labor and job reports, just certain industries were hit harder than others. Those can eliminate some of the noise. Maybe this puts us right back on track of where we have to be. But for the first time in a long while, I think there is, depending on who you talk to, some people think that we're at the neutral rate and maybe we just keep rates as is for the time being and don't have to make any knee-jerk reaction. There are still a lot of doves out there that think that we should look more at the core inflation numbers, and then the inflation picture is improving. We got a jobs report out this morning that actually came in much weaker. So the Doves will tell you that we have to decrease levels to support the job market, support the equity market. Devil's advocate will say that a lot of that was skewed by some of the climate and some of the geographical things that happened over the last month or so. And then there are others in the camp, the true hawks, that will say that the next move should actually be up rather than down from a rates perspective. So a tightening. So there's not as much conviction in the market right now, and there's a lot of different views. So I think it'll be interesting to see how people play that from a deployment of cash perspective. Most people running sec lending portfolios tend to take a Fed agnostic type view and don't really want to be caught one way or the other from an interest rate surprise. So I do think that means more cash being hoarded pretty short. And maybe that does help as it move levels wider, and those that want to take maybe some duration will get paid for it. But I think it's definitely you have to wait to see how that plays out. So I think there's varying dynamics here that maybe we didn't have as much during Liberation Day, which seemed to be resolved all within a month time frame. Like even looking from a Mark's perspective, the equity markets got back to where they needed to be or where they were pretty shortly after. And this one also has, from a Mark's perspective, treasuries and equities are selling off in tandem. Usually when you get the inverse correlation of at least you get some treasury marks to offset equities or vice versa, these are coming off in tandem. So that's obviously hurting portfolios that have a suite of sec lending products.
So it sounds clear as mud, right?
Right. I
Yeah,
was going to
exactly.
say there's
And
a lot of uncertainty. We'll know more. I
yeah.
guess we're always going to know more in the future, but it does feel like maybe if we can get ourselves to June, we'll have a much better sense of whether this has turned
Yeah.
into
Yeah.
a conflict that is going to be sustained and or is it truly something that's short, and then with the Fed changeover, you'll have more clarity hopefully at that
Yeah.
point come June. So
I
I
think
don't know.
I think that's a good point. I think June's an interesting month because in theory we should have a new Fed chair. But there's a chance that's still lingering from a Senate confirmation. June will also be their first opportunity post Powell to have an FOMC meeting. That's really where you start seeing some of the probabilities of a cut taking place. That was in June. It's since backed up. And then in our world, it's also a quarter end, which Mark mentioned. We do sometimes forget about Q1 because it does come up so fast. Everyone has new initiatives, new goals, and transactions you're working on for the new year. And first quarter tends to be a little bit maybe more lenient from a balance sheet and flows perspective. That Q2, you start to really get a better picture on how dealers and borrowers are looking from a regulation and balance sheet perspective for the rest of the year. I think those three factors, from the Fed transition to the FOMC date, which is the next opportunity to alter monetary policy, and then quarter end, I think it could be a busy back half of June.
It's also my birthday month, so I like
Yes,
to think
yes,
about June as the start of a
that's true.
new season. All right. So this week, a lot of the market came to Boston for the first ISLA Americas Briefing event, which was, I thought, a big success. Mark, I know you were there as well and spoke on a panel. I had the pleasure of moderating as an ISLA board member, but I thought it was a great event and some of the topics and themes covered. Obviously, a lot of kind of current market activity outlook, but there was a lot of updates with regards to some of the regulation that's pending. There's great expectation that the US market will get updated information on the Basel III proposal from the regulators in the US very soon, and that could provide a lot of clarity. And I think people generally have positive expectations versus the prior proposal, and that the advocacy done in the last couple of years was successful, and maybe the new proposal will be either neutral or even better for the banks and the global banking system in the US as they look to implement that perhaps even before the midterms this year. We'll know a lot more in the coming probably month or two there. We also are hearing that we might get news around the long awaited 15C3 around equity collateral for US brokers. And again, there's an expectation that will be positive for US brokers and that they will be able to post equity collateral versus equities for limited large cap indices. So we'll perhaps know a lot more in the next month or so as we podcast more between now and quarter end. But I know that those topics came up, as did some discussion around digital assets, also some discussion around market protocols for the fix community and fix messaging around supporting, it sounds like maybe first and foremost for the securities lending market, standardized messaging around trade execution, front end trade processing, which is exciting. And I know there were a few market participants that are very active in that space that really did a great job of educating the broader audience. Mark, what else did you think about that event? Any other comments or takeaways that you had?
Yeah, thanks to ISLA and Fidelity for putting it on. It was a great event, like
Yes.
you said. I think part of what I really appreciated was the diverse opinions during the fix panel.
Mm.
I guess it was due to my own ignorance. I was not as aware of what fix was only 6 to 12 months ago. I think a few other people were willing to admit that when I chatted with them. I think it's worked for a long time, right? So anything that's worked for a while and has value tends to make sense to adopt. One of the panelists put it really well. He said, look, I just want to move in the direction of what's going to help create the least amount of friction and require the least amount of resources
Yeah.
for automating in the future, which I think this is a clear path towards that goal. But there really was a diverse set of opinions on that panel. So I appreciate that conversation. What was your take on it?
No, I thought it was also interesting, even though I've heard a lot about it in the market over the past number of months. I also learned a lot in that discussion, and by no means I'm an expert, although they were pretty detailed. And Mark Whipple did a great job of moderating that conversation because I think he allowed them to start at the beginning and to actually educate people and bring them all up to speed to hopefully achieve a similar understanding and level. No, it was great. And I think a lot more to be probably learned across the market. But yeah, I thought it was an interesting conversation. And I think I'm constantly, I think, in any conversation around technology and automation and new trading tools or post trade tools or full life cycle benefit that the market has to offer. I'm always trying to wrap my head around the okay, if this, then what not? Or what are the decision making trade offs? Because you just referenced it. Everything in our business and our industry is a decision around cost, resource allocation, time and effort spent on it. The panel that you were on spent a lot of time talking about all of the demands that are present in the market currently to better meet borrowing demand and need around whether it be capital efficiency or trade automation, operational processing, whatever it might be. You're never short on projects that can be pursued in terms of improving trade structures, improving how you process and support. And so I'm always trying to understand that if you're making a decision that goes one way, what are you comparing that against and what are the other alternatives? And I have a better feel for that. And I think what I took away was that fix does a lot to then open you up to being able to be far more efficient in implementing other solutions once you have it
Yep.
in place, which I thought was the key takeaway. Thought it was interesting.
What did you hear that maybe you didn't expect to hear, or what was something new that you didn't know already, or what was Brooke Gilman's highlight or like fun factoid?
Now I want it to be fun if it's a fun factoid. It probably was on the fix conversation. I
Yeah.
think that that was probably the most informative to me, but it's also the thing that is the newest and I was least familiar with. Yeah, just understanding what it really is. And maybe we should even, frankly, I'm now coming up with the idea like maybe we should invite some of the fix working group folks on this podcast. And maybe it's another route to get that message out there to the market and what they're working on, because I did learn quite a bit. So,
Yeah.
yeah,
Yeah.
that was my aha moment.
Yep.
All right. We did have a couple questions come in my effort to canvas the market for questions for this podcast. So we actually had two questions come in. I'm going to save one for Jim whenever we can pin him
Good.
down when
Yep.
he returns from Asia. He'll probably be jet lagged and extra cranky. So it'll be good to ask him a challenging question.
Is that about his
But
hair product or?
no, it's not. I'm really hoping someone does put that forward. So,
Sure.
listeners, if you could support that effort to ask Jim the hard probing questions, that would be great. And maybe Mark, this might be more for you, but Mike, you might have an opinion too. But the question is, how do you feel digitally native assets, e.g., crypto, will converge with real world assets from a financing perspective? I.e., will we see them lent and used as collateral in the same way as they gain institutional adoption? Do you have much of a view? I know we talked a little bit about your own sort of tracking attention that you put towards digital assets and crypto and such. Do you have much of a feel for how we could eventually see it converge in kind of our financing space?
There's a crypto native company, more than one, but there's one really large publicly traded crypto native company that has a prime finance group today. So I think they're replicating a lot of what would be considered traditional finance to the extent that broadens to traditional finance players and banks, maybe through the Clarity Act. You could see everything that is being done today replicated with whether it's something as simple as a stablecoin, which presents a relatively low amount of risk, but is certainly digitally native, to digital currencies, Bitcoin as collateral and things like that. Bitcoin in repo, obviously these things or some of these assets have a ton of volatility. There's been an evolution in the lending space to take different types of collateral over the years. I don't know if 30 years ago people would have thought that you'd be accepting global equities, and we're here today.
They were focused on letters of credit back then, so
Exactly. Yeah, so
we have matured.
it's the natural evolution as long as it makes sense from a risk standpoint. Volumes will be there to support it. You would think that they would be used as collateral, and then you'd think as more institutions hold these things in their long portfolio, the lending of them and the trading of them would extend beyond just digitally native companies. So I think that it will happen. The speed at which it does, who knows? But I think a lot of it probably resides in DC right now with the Clarity Act.
And then I think just seeing institutional adoption in these markets is also something that probably needs to happen to have it truly become more material in the financing markets over the long term.
Sure. Yeah.
All right. Anything else? Mike, did you have an opinion on that?
Yeah, I'm not so much an opinion. I'm by no means an expert. We are hearing a lot of conversations around the tokenization of repo, though, converting the traditional slow settlement cycle, kind of manual processes into digital tokens on blockchain using smart contracts to get around some of the interest calculations and the DVP settlements and the intraday liquidity issues that arise in traditional repo trading. The repo business is obviously a mature business. I think through this tokenized product, the goal is to optimize capital efficiencies, manage liquidity more efficiently. It will limit the risks associated to operational risk, which obviously limits fail charges and overdraft charges and things like that. So I think I'm, at least from my perspective, definitely more in the education phase right now, but it's definitely something we're hearing more and more about.
Okay, good. All right. If we all have long enough careers, maybe we'll start to see some of this and participate ourselves directly.
Brooke, you're off to PASLA next week.
I am off to PASLA. It's my first opportunity to get to attend that conference, so I'm looking forward to it and should be a really good one. They have great attendance. I know it's one of their probably largest conferences yet, and I think great content and speakers, and I'm looking forward to learning and just better integrating with that community attending PASLA. I head out tomorrow and coming back at the end of the week, and should be a good one. We'll look to pod afterwards. I tried to nail down Jim Maroney to pod while there, which I think was actually his idea anyway. Or maybe it was your idea, Mark, but he is, what do you call it when you weave and bob and try to avoid committing to something?
He's been shifty.
He's been shifty.
Yeah.
What do you do when you play basketball? Good defense?
Yeah, maybe that's more of like
he
an
loves it when I
offensive thing
use
where you're
sport
trying
ball
to,
analogies.
I think shifty works in basketball too.
Shifty?
Yeah.
Okay.
He's been running off a couple screens.
Okay. Anyway, he did actually give me a no. He's, I don't have time for that. I'm like, you don't, yes.
When you're trying to triangulate with Mike and I, we're like, we're the time zones, this doesn't work. Like, just if you guys want to do it, you do it.
Yeah.
Because everyone's going to be looking forward to your wrap-up pod.
We will do a wrap-up pod. Mark, you'll be on vacation, but we'll wrap it up afterwards with Jim. So yeah, assuming he can recover reasonably from his jet lag, we'll get on the mic pretty soon thereafter.
Sure.
But no, it should be a great conference, and I'm really looking forward to it. So thanks to the PASLA team for organizing and doing all the preparation, and the industry is excited and ready for it. And actually, the other question that I have in already from our audience, I think will be best asked after PASLA. So I'm going to surprise Jim with the question after PASLA and see if he paid attention during his week over there.
Sounds good.
All right. Thanks, Mike. Thanks, Mark. Have a good rest of the day. Good weekend, listeners. We will talk to you soon. Wish us luck out in PASLA and wherever you're going to be in the next week. And we'll try to hit you the week following with a new pod to give you our perspective on how everything went. Thanks all.
Bye, everyone.
Thanks, guys.
Bye. Thanks for listening. And now for our disclaimer.
This material is for your private information and does not constitute legal, tax, or investment advice. There is no representation or warranty as to the current accuracy of, nor liability for, decisions based on such information.